You can use options to predict stock price movements. For assets of a certain size, prices aren't just set by spot buying and selling pressure. Most institutions and fund managers buy assets on a portfolio basis, and in that process, they build option and futures positions. Bitcoin has now joined the ranks of major assets and is starting to be included in institutional and pension fund portfolios. High capital players earn profits by adjusting their portfolios, especially through options. Their primary strategy is the delta hedge strategy. Now let me explain this simply, leaving out all the difficult parts. Delta hedging is making sure the portfolio value doesn't change whether the underlying asset price goes up or down. Let me give you an example. Let's assume you hold 100 shares of Apple spot stock and the delta is 100. To hedge the delta of 100 Apple shares, you buy 2 Apple put option contracts with a delta value of 0.5. Here, one option contract corresponds to 100 shares of spot stock. If you hold 100 shares of Apple spot stock and put options in your portfolio like this, the delta value will be set to 0. When delta becomes 0, directional risk is eliminated. If the stock price rises, you profit from the spot, and if it falls, you profit from the put options, protecting your principal. While protecting the principal, premium income is generated from the options Theta and Vega. Options lose time value every day from the moment they're bought, but if you sell options and set delta to 0, you can secure a fixed profit regardless of price direction. In the case of spot assets, profits are generated through dividend income. Since you can profit whether the price rises or not, the delta hedge strategy is about securing fixed rewards rather than timing market fluctuations. Now that you know the delta hedge strategy, you can use it to ride on the massive capital of market makers. Let's take Bitcoin as an example. Now, the screen you're looking at is the Bitcoin March option expiration. If you look at the implied volatility, there's a number in parentheses, which is the market maker's hedge range. High implied volatility means high volatility, and it also means the hedging cost is that much higher. Since Bitcoin is a high volatility asset, it goes up to 70 to 80%, so this level is quite average. To find the market maker's hedge range, just add and subtract the implied volatility value from the current price. Now, since the price is 71,266, the implied volatility value is minus 7,177. Now, 71,273 minus 7,178. Now, that's 64,105. Now, let's mark the value 64,105 on the chart. 64,105. Now, similarly, the current price plus 7,982. Then it's 79,259. Now, if you put the calculated values on the chart, support and resistance lines are created above and below. Market makers hedge within this range to keep their delta at 0. All we have to do is bet in the direction of the hedge.